If you had to choose just one mid-cap mutual fund to lock your money into for the next 10 years, which one would you actually pick? It's a massive question. Today, we're diving into this explainer to look at an absolute heavyweight clash between two of India's biggest mid-cap mutual funds. On one side, we've got Motilal Oswal Midcap Fund, and on the other, HDFC Mid Cap Fund. Both of these are giants in the wealth creation space, and honestly, both have delivered really impressive long-term returns. But when you look under the hood, they operate completely differently. So we're going to break down the data, the strategies, and the real-world risks to see exactly what sets them apart in 2026.
So here's the ultimate scenario we're trying to figure out today. If you had 10,000 rupees a month to invest through an SIP for the next decade, where does it go? Do you side with the aggressive, high-conviction challenger, or do you play it a bit safer with the established, diversified giant? It's a genuinely tough call, and as you'll see, the right answer depends entirely on the kind of ride you're willing to take. To set the stage here, we're basically comparing two completely opposite philosophies. We've got Motilal Oswal's heavily concentrated, super aggressive approach squaring off against HDFC's massive, highly diversified, and relatively smoother strategy. Both funds play by the same SEBI rules, meaning they have to keep at least 65% of their assets in midcaps, and they both track the exact same nifty midcap 150 benchmark. So this is a true apples-to-apples comparison. But keep their distinct personalities in mind because it explains literally everything we're about to see.
Now, real quick before we go any further, just a standard but important reminder. This explainer is strictly for educational and informational purposes, so please, always consult a SEBI-registered financial advisor before making any investment moves. Both of these funds carry a very high-risk classification, and, as always, past performance is absolutely not a guarantee of future returns. Okay, let's get into it.
All right, round one, size and history compared.
So looking at their history, both of these funds have successfully crossed that crucial 10-year milestone, which is great because it means they've survived multiple market cycles. But HDFC holds a slight advantage here. Their current scheme dates back to January 2013, whereas Motilal Oswal launched about a year later in February 2014. It's a small gap, but HDFC is the slightly older veteran.
But then we get to the size, and wow, this number is just staggering. As of mid-2026, HDFC Midcap manages over 1,05,000 crore rupees. Let that sink in for a second. That AUM makes it an absolute mammoth in the mid-cap category. It's almost 3 times the size of Motilal Oswal. It's not just a big fund, it's practically an institution on its own.
But, you've got to ask, is bigger always better? Well, not necessarily. HDFC obviously has incredible scale, a massive investor base, and unshakable stability. But Motilal sits at a much smaller, though honestly still huge, 37,000 crore rupees. And in the mid-cap space, having a smaller asset base is often a superpower. It potentially gives Motilal the agility to jump in and out of opportunities that a giant fund like HDFC might struggle to touch without moving the entire market.
Okay, moving on to round 2, the ultimate return scorecard.
Now for the part everyone cares about most. Looking at the data from around August 2026, a really clear pattern jumps out right away. In the short term, just looking at the 1-year mark, HDFC completely dominates. They posted a solid 10.6%, while Motilal actually dipped into the negative at roughly -2%. But zoom out to the longer horizons, Motilal Oswal edges ahead in both the 3-year and 5-year long games, delivering an impressive 22.7% over 5 years compared to HDFC's 20.2%.
So Motilal takes the crown for long-term historical returns. But, and this is a massive catch, higher returns do not come for free. And by price, I'm not talking about expense ratios, I'm talking about the emotional toll on you, the investor.
Which brings us right to round 3, the catch, also known as market volatility. This data point explains so much. We're looking at standard deviation, which is basically a fancy way of measuring how wildly a fund's returns swing away from its average. Think of it like a roller coaster. The higher the number, the wilder the ride. At 20.5, Motilal is significantly more aggressive and volatile than HDFC, which sits at a much calmer 15.3. When the market surges, Motilal flies, but when the market struggles, it falls much harder. And you can literally see why this happens when you peek inside their portfolios. Motilal takes massive, concentrated bets on single stocks. Look at their allocation. Over 7% in 197 Communications, over 6% in Coforge. If those specific companies have a bad quarter, the whole fund feels it instantly. HDFC, on the other hand, strictly caps its individual stock exposure, usually keeping it under 5%, and spreads the risk across 75 to 80 different companies. It's the classic, don't put all your eggs in one basket approach.
So let's unpack the why behind those portfolios. Round 4. Inside the investment strategies?
Motilal Oswal absolutely swears by its proprietary QGLP philosophy. That stands for quality, growth, longevity, and price. In plain English, this philosophy drives them to make really high-conviction, long-term bets on a very select few high-growth businesses. They basically find a company they love, and they back it heavily.
They literally label their approach as building high-quality, high-growth portfolios. What this means in practice is that Motilal's managers are perfectly willing to endure sharp short-term drops. Why? Because they are laser-focused on capturing the massive upside of these mid-caps during bull markets. They are hunting for maximum alpha, and they fully accept the turbulence that comes with it.
On the other hand, HDFC's fighting style is all about endurance. They run a highly diversified, low-turnover strategy. We're talking a turnover ratio of just 10 to 15%, which is incredibly low. They buy quality stocks at reasonable valuations and they just hold them. They prioritize risk management and steady growth over chasing dangerous market momentum. They aren't trying to shoot the lights out every month. They just want to steadily, consistently compound your wealth.
All right, final round. Which fund actually fits you? So who is HDFC really built for? Well, it's pretty much the perfect match for the steady wealth builder. If you want solid exposure to the growth potential of mid-sized Indian companies, but you prefer a smoother journey with a lot of diversified safety nets, this is your fund. It's for the investor who doesn't want to lose sleep over sudden market corrections.
On the flip side, Motilal Oswal is tailor-made for the truly aggressive investor. If your goal is to maximize your long-term gains, you believe in the power of concentrated stock picking, and, most importantly, you have the emotional discipline to not panic sell when the market takes a dive, this fund offers the high-octane engine you're looking for. Ultimately, the best fund in 2026 isn't just about looking at a spreadsheet and picking whoever had the highest historical returns. It's about matching a fund's specific risk profile with your own emotional tolerance. Because at the end of the day, the best investment strategy is the one that lets you sleep peacefully at night while your wealth compounds in the background. So, I'll leave you with this. Are you looking for a smooth, steady ride, or are you ready to strap in for aggressive, bumpy growth? The choice is completely yours.